There are incredible tax benefits to oil and gas investments. So today, I'm going to break them all down for you so you know exactly how you can save a fortune in taxes if you decide to go in oil and gas before the end of the year. Without further ado, let's dive in. All right, guys, what are oil and gas investments? Oil and gas investments are investments that you make into businesses that drill for natural gas or crude oil. You're not going to be doing this yourself. You see, natural gas is a fossil fuel composed mainly of methane, along with smaller amounts of other hydrocarbons like ethane, propane, and butane. It is commonly used for heating, electric generation, and of course, the fuel of our vehicles. Now, crude oil is a naturally occurring liquid fossil fuel made up of complex mixtures of hydrocarbons. Crude oil is refined into various petroleum products such as gasoline, diesel, jet fuel, and even lubricants. So, just like natural gas is also used for fuel, it is used for power, and is used to heat things. There is also a wide array of other uses for oil. Now, what exactly are the tax benefits of oil and natural gas investing? Oil and gas ventures offer substantial tax incentives, particularly through deductions tied to key drilling expenses. These primarily fall into two separate categories: intangible drilling costs and tangible drilling costs. Together, they can dramatically reduce your taxable income, but you need to know the differences. Tangible drilling costs, or TDCs, cover the expenses for physical assets involved in well development, such as drilling rigs, casting, and wellhead equipment. These typically account for 20 to 40% of overall well drilling expenses. Under updated U.S. tax rules effective for wells starting after January 19, 2025, per the Big Beautiful Bill, TDCs now qualify for 100% bonus depreciation. This allows for the full deduction in the year that they are incurred rather than spending and spreading them over 7 years as previously required. This shift provides immediate tax relief for you, the investor. Now we need to talk about intangible drilling costs. Intangible drilling costs is what you think. Something that's intangible, I can't necessarily touch it. These are expenses essential to well preparation besides the actual drilling equipment. They include labor, they include surveying, they include site clearing, fluids, fuel supplies. These often make up 60 to 80% of the total drilling costs. For independent producers, I repeat, for independent producers, intangible drilling costs remain fully deductible in the year they incur, offering a very powerful upfront tax benefit. Now, this structure results in a significant tax savings because both IDC and TDC deductions offer a large percentage of your deduction in the first year. Now, to understand the impact of these deductions, imagine you invest $200,000 into an independent oil operation. In the first year of your investment, you might deduct $120,000 all the way up to $160,000 solely from intangible drilling costs, plus potentially the full tangible drilling costs under the new bonus depreciation rules. This means you could potentially write off your full $200,000 investment in year one. For taxable income at the highest tax brackets, 37%, you'd be looking at close to $74,000 in taxes saved. So if you made this investment and if you were in the highest tax bracket, yes, you would potentially save $74,000 in taxes while acquiring a stake and an asset that generates cash flow for you for many, many years to come. Not bad. Keep in mind that certain oil and gas investments allow you to use losses to offset active earned income. This is your W-2 or your 1099 income, which can amplify the tax benefits you receive. Now, before we move on, I got to remind you guys that my Tax-Free Millionaire Summit is right around the corner. Spots are disappearing quickly. So over these 3 days, I want you to know I'll teach you every cutting edge strategy that I've learned. I'm going to cut your tax bill by 50 to 100% using real estate strategies, income shifting techniques, entity structuring secrets, and much more. This is your chance to finally take control and start creating lasting tax-free wealth for you and your family. Click the link in the description below to grab a spot. Now back to this video. Another key incentive is the percentage depletion allowance, which shields 15% of gross revenue from oil and gas production from federal taxes for qualifying small producers and royalty owners. This applies to operations meeting specific production limits, effectively making a portion of your returns tax exempt, and obviously it encourages investments in smaller scale projects. projects. It's a long-standing benefit that has been unchanged in 2025, and it draws many new participants to this industry. Now, how do we navigate oil and gas investments? Investors can invest in oil and gas through various different structures or formats, each with distinct tax implications and risk profiles. Here are a few common approaches that I want you to understand. Number one is working interest. With a working interest arrangement, you acquire a direct ownership share in the well, sharing both operational cost and a share in the revenues. This structure unlocks the fullest tax perks because participants shoulder the setup fees, the operational expenses, the IDCs and TDCs that we outlined earlier. And of course, with the 2025 Big Beautiful Bill, this could mean deducting nearly the entire investment amount in the first year against any forms of active income, bypassing passive loss restrictions from the 1986 Tax Reform Act. Losses from working interest aren't deemed passive, so they can offset earnings from jobs or businesses, potentially yielding massive tax savings. Working interest often requires substantial minimum investments such as thousands to tens of thousands of dollars. So keep that in mind. Most of these opportunities are reserved for accredited investors. An accredited investor is a person with a net worth exceeding $1 million, excluding their primary home, or an annual income of at least $200,000 individually or $300,000 jointly for the past 2 years, with similar expectations ahead. Now, higher income individuals may find working interest ideal for tax optimization and portfolio growth, but there's also another way you can invest through royalty interest. Royalty interest grants rights to a share of extracted resources without operational liabilities. So the holders receive payments based on production volume, but they avoid drilling or maintenance costs, which dramatically reduces risk exposure. Since there is less risk, there's also fewer tax benefits. For example, there is no access to IDCs or TDC write-offs, but you still get the 15% depletion allowance, and you can exempt that portion of income from your taxes. Royalty earnings are typically reported on a Schedule E on a 1040 tax return. This option is good for those who prioritize steady income and lower involvement over maximizing deductions. Now, if tax minimization is your main goal, a working interest might outperform, but royalties provide diversification and cash flow with less upfront commitment. Now, what about purchasing oil and gas through stocks? Purchasing oil and gas stocks can be an easier way for people who are new to the energy sector to make an investment. There are many publicly traded companies involved in oil and gas exploration. There's companies involved in the production, the servicing, and they're available on major stock exchanges. However, unlike working interest investments, oil and gas stocks do not provide deductions for drilling cost. They're just subject to capital gains taxes and dividend taxes. Holding these stocks for at least 1 year before selling qualifies you for long-term capital gains tax rates, which are 0, 15, and 20%, depending on your income. This tax advantage, combined with the potential portfolio diversification, makes oil and gas stocks an attractive option for investors seeking exposure without the operational cost or liability. Now, why does the government provide tax breaks for oil and gas investments? Have you thought about this? Government provides powerful tax breaks for oil and gas investments because energy production is essential for healthy functioning of our nation. After all, if we couldn't power our vehicles, if we couldn't heat our homes, if we couldn't generate electricity, then we wouldn't be here in this country that much longer. So just to make sure that we all are on the same page here, there are tax codes that are simply set up for taxpayers like you and I to go do things that the government just can't do enough of. Oil and gas is that sector. Our country would be in a whole lot of trouble if we didn't do oil and gas investing. To make sure that we always have enough people drilling for oil and gas, the government incentivizes this activity by providing massive tax breaks for oil and gas investors. You can think of these tax incentives as like being a reward for investing in things that the country really needs. In this way, oil and gas investments are similar to real estate investments. The government also provides massive tax breaks for real estate investors because just as our country really needs energy, we also really need affordable housing. But what are the risks of oil and gas investing? Now that we've covered all the tax benefits, we covered all the different ways to invest, let's talk about the risks associated with oil and gas investing. Of course, not every oil and gas well is going to produce. Some of them come up dry. So right off the bat, it is not a guarantee that the oil and gas well that you invest in will produce. Also, sometimes there are mechanical or operational failures. However, you can increase the odds of success by working with a reputable company. Investing in oil and gas is just like investing in anything else. You're going to have to do all this due diligence. And the more research you do, the more you'll likely be to succeed. Some people generate tremendous wealth with oil and gas investments and some people don't. But the good news is that when an oil and gas well does produce, it can be extremely profitable. If you own a working interest or a royalty interest in the well, then you get access to a percentage of the cash flow flow over the course of time. This could even be decades to multiple generations. Yes, many of these wells won't run dry for many decades. My family has oil and gas wells that we've inherited from my grandparents. If you want to learn more about investing in oil and gas wells from a tax benefit, highly recommend that you reach out to my company if you are ready to do tax planning. We work with high net worth individuals that are making over $250,000 W-2, $500,000 self-employed, and we will help you qualify for a lot of these strategies. If you have enjoyed watching this video and you're looking for more strategies that can help you reduce your tax bill by also opening up the ability for you to earn cash flow, I would highly recommend you get on a call with a tax alchemy advisor so we can go over our options with you. Thank you so much for watching this video. If nothing else, like, comment, subscribe. I look forward to seeing you on the next one. Cheers.